It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Welcome back. Oh, man, I feel like we've been off for a while. And may I say, well, first let me welcome Professor Rick Plum. Hello, Rick Plum.
Hello. Happy New Year.
Johnny Dean here. Happy New Year to you. It is 2023. It looks still a lot like 2022 outside, but we welcome you back. We've been off for the last 3 weeks. We take our break in between the seasons, if you want to call it that.
At the risk of sounding very old, I wonder how long it'll be this year before I actually write a check have to put 2023 on it. I don't write very many checks anymore.
Well, and that's the problem, because when I write checks, I don't even know what year it is. So I have to think, what year is this? I know it's 20-something.
The fact that we're talking about checks is showing our age.
Isn't it, though? Isn't it? It's really quite wild. My daughter, over Christmas a couple of weeks ago, was addressing envelopes. That's something else that her generation doesn't really do. And I was impressed. She knew to put the return on on the left, and then
left.
Yeah, and then do the addresses. People today don't sound stupid, but kids today, they don't all know how to address an envelope, because how often do you send a letter anymore?
Or a card.
Really? I don't get that many Christmas cards anymore. So anyway, here we are in the new year.
I don't know if those two go together, though.
Well, they probably don't. I sent Christmas cards years ago, and I did it for a while, but it became such a chore to get, it was just one more thing I had to do. And so I quit, but I still enjoy getting them. Anyway, we're past that now. We're looking forward here to 2023 and some things to talk about, some things to take care of here in 2023. I know we talked last month about things you want to take care of before the end of the year. Now we've got taxes coming up, to be sure.
Getting ready for them.
We are. You really have to think about this. Once you've finished paying all your holiday bills, your Christmas bills, and all that stuff, now you've got to look forward to paying your taxes.
I was in the Costco a couple of weeks back, week or two ago now, and the TurboTax you can buy them now.
Oh yeah.
You can buy them there already, and it's like, wait a minute, the year's barely ended, if any.
Yeah. Oh, I'm getting TurboTax emails saying get your early thing in now. So I don't know if anybody's really thinking about them yet, because most people, I would assume by now, haven't gotten their W-2s yet if they're listening live. But in some cases you may have, or at least you know how much you're going to make. First of all, let's talk for a moment about the new limits on things like 401ks and all that stuff. Is there anything new in that regard?
Well, we got a nice increase. If you are maxing out your 401k, we've got a pretty nice little bump in that area. It was 20,500. Now it's 22,500. And the catch up for the older people, the seasoned individuals, went from 7 to 7,500. So it used to be 27,000 max if you're a 50-year-old, and now it's 30,000 max if you're. So if you're of the ability, if you have the ability to max out your 401k, and you want to put that increase in and let it go. Now, I surprised this. I was talking to my son the other day, and he was thinking about changing his allocation on his 401k. He didn't like losing money. I said, the money you have in there now is not the issue. It's the money you're going to have in there. You want to keep saving as much as you can into the growth. He goes, but I don't like seeing it go down. It's like, you want it to go down right now. I don't, because I don't want to. But you've
got 30 years.
You want to accumulate as many shares as possible while the market's down.
Yeah.
And so don't shy away from being a growth investor. Just because the market's done what the market's done for the last year.
Don't even look at it. Don't open a statement. It doesn't matter.
And he's 30-something.
Yeah.
Okay, I'm not. And so I have
anymore.
different, but I take care of that market volatility through a different means by keeping some money on the sidelines. Not my new contributions. They're going growth.
No, and somebody that age is not going to care. They're
he's
happy
got 30
to have
years.
Exactly. So we have new limits on 401ks.
New limit on the IRA, but not on the catch-up. So we got a $500 increase on the IRA.
For 2023, okay,
but
good.
the catch-up didn't increase.
Nope.
All right. It's still the same.
Okay.
Same thing with 457, 403Bs.
They're all the same. Yep.
Simples went up. If you have a simple plan at work, you can and put more into that. So yeah, we've got the ability to save more.
Nothing changed as far as taxes go that we could see. Nothing major.
Nothing dramatic in the tax world. I mean, obviously, every year the amount of money that we can make in the 10%, 12, 22, 24, in the individual, the brackets,
ratchet up.
The percentages didn't change, but the amount of income we can have in each of those brackets has gone up a little bit. And it happens every year where they're all indexed to inflation. It was a decent increase this year because of inflation being a decent number or indecent number. But standard deduction is higher. I was going to say personal exemptions. We don't have those anymore yet.
We may in a couple of years. We may in a couple of years.
2026.
That's right.
But yeah, so if your income is identical in 2023 to what it was in 2022, you'll have a little bit lower tax bill, like any other year. But this year's the increases were a little bit more than normal.
Yes, and again, it's only because of what they call the ratcheting up of the tax.
Right, they are inflation
tax
index.
Brackets. Correct. So if you
so you got that to look forward to.
Yeah, you do have that. This is some of the stuff that you need to think about. We're talking here for a moment about other things that you might want to think about, in no particular order. You mentioned the change in the tax brackets, the ratcheting up of the tax brackets, but there's also a change in what's known as the Social Security wage base. Now, we'll get into that for just a moment. It doesn't affect everybody. You have to be making a pretty decent amount of money. Right.
And for 2023, you have to be making a more decent amount of money. The Social Security tax, the FICA, that the employer withholds from your paycheck if you're an employer or employee, you have 6.2% of your salary withheld and paid for. It goes into FICA, goes into the supposed Social Security Trust Fund.
That's your premium that you're paying to be a part of the Social Security Club.
And your employer pays the same amount on top of that.
Yeah.
So between the two of you, there's 12.4% coming out. Now 6.2 of it's coming out of your paycheck. They do that all the way on all income in 2022. Up to $142,200, I think it was. And once you get to that level, if you're blessed enough to have an income higher than that as an individual, then you stop paying into the Social Security system for the remainder of that year. And so your salary is set, your income is set, you no longer pay FICA tax. Now, it doesn't mean that you're getting a free ride on Social Security because they're not going to use your higher income as part of the base of the formula to determine
they're going to ignore that benefit. Income.
So they're going to use the 140. That number has gone from a roughly 142 to 162.
Wow. Was it 142 or 147?
147. 147. You're right. I'm sorry. Went from 147 to 160. 200. 162, 200?
Yeah, I believe so, yeah. I don't have it in front of me, but it seems
but it was a pretty good sized jump. So if you are used to getting a little bit of a raise, take-home raise, I should say, at some point in the year, because once you passed over the wage base, they no longer withheld the taxes, which meant that your take-home pay grew by that 6.2%.
It's 160,200.
160,200.
160. Yeah, we don't. 160,200.
So it went up 13,000. So
that's
you'll
that's
be paying
a lot.
tax 6.2% on 13,000 this year that you weren't last year. So if you were used to getting that pay raise or that take-home pay raise at some point in the year, it's going to be later in the year that you get that pay raise this time.
Yeah, what happens is, as you were saying, let's say I made $320,400, right, this year. That'd be nice. But if let's say I did, that would mean that halfway through the year, assuming I make the same every month, I about halfway I would hit the 160,200 mark.
And if you made that same amount in 2022, you would have hit it in May.
Yes, I would have hit it in May, and this year I'm going to hit it at the end of June. Hit it at the end of June, July 1st, whatever it is. So that's what that means. So
look forward to that pay raise later in the year if you are so blessed.
The Medicare premium does not.
It's on
change.
Everything. So if you're one of these athletes that gets 20, 30, 40, 50 million a year, you get the privilege of paying your Medicare tax, which is 1.45 employee, same thing for employer, on all of that. And if you're over $200,000, you pick up another 0.9%.
That's the
that's part of the Obamacare, but it's a Medicare tax.
Yeah, it's a Medicare tax, right? The name the name is there's a name for it. What is it?
It's additional Medicare tax. It's not the NIIT.
No.
Not IRMA.
Wasn't there an
a peak
acronym
earnings
for it?
tax? I mean, I don't.
I
not
thought there
that I
was.
know.
No?
I mean, maybe there was.
All right. Anyway, doesn't matter. There's an extra tax for that. So anyway, if you are lucky enough to be making that much money, you will see a pay raise. So one of the things you might want to think about if you happen to get over the wage base, and maybe you weren't expecting to, but let's say you are, is it a good idea, Professor Plum, to maybe take that raise and use it to your advantage in some ways, or is just spending it better?
I have a hard time ever giving away, not taking a raise. I mean, I just, on principle, even if it costs me a little more in taxes as a percentage of that portion versus the other portion, I'm still going to take the raise. So let's take the raise. Don't be foolish on that. Get the money. You're going to pay a little more for it, so your take home may be a little, but always take the raise.
But what I'm saying is can you use that maybe and increase maybe send it to your 401k if you're not maxing it out or whatever?
Use it, that will help you on your income taxes.
Yes.
So if you're getting a raise, I would say if you're getting a raise and you're saying, well, I don't know if I can afford to save much, split it. Send part of it to the 401k and take part of it home so you give yourself some breathing room on the budget at home. But save some of that raise if you got a raise.
All right, so the wage base goes up, as we said, in 2023, as it does most years.
Goes almost every year.
I don't know if
this was a big one.
Yeah, this was a bigger one than normal.
We were expecting, though, because we had high inflation, high CPI. We got a huge, what I would consider to be a huge jump on Social Security benefits.
Sure.
So, we were expecting a big wage increase.
All right, so that's something to look out for. Beneficiaries. Now, it's probably always a good time when you review your financial plan to check your beneficiaries, but why is now maybe a good time to?
Well, just from a pure fact that most people have just spent a lot of time with their family, and they're realizing the holiday, and they're realizing I want to leave money to these people, and maybe I don't want to leave money to those people.
I no longer like you. We got in a fight at a New Year's Eve party or whatever, and I've decided I spent too much time with you, so I'm taking you out.
But now's you're thinking about family. Now's a good time to review who you would like to receive what's left over of your estate. If you're a single individual, that's a bigger question. If you're a married individual, generally it's the spouse. But what happens if the spouse isn't there to inherit it? How do you want to split up the rest of it?
Yeah, it's always a good idea, and I think a lot of people don't necessarily they set up their estate plan maybe at some age, and then they kind of tend to forget about it. I know that when you guys do reviews,
we try to review beneficiaries, but we don't always get a chance to review the entire estate plan.
Sure,
and sometimes documents grow stale. It hasn't happened for a while, but I remember for a while when banks were being bought out and, gobbled up and consolidated, you're looking through somebody's trust and it says the bank, a specific bank account. And well, that bank hasn't existed for a number of years.
It was a savings and loan. It was what it was from the 80s. No,
I was thinking of a different one, but
I know.
It happens. So make sure that if you've got things up to date. And I mean, now is as good a time as any. New Year's resolution, I'm not a big fan of those because most people have probably already broken all theirs.
The average New Year's resolution lasts, I think what I saw was 2 weeks.
Okay, so we're in the grace period right now.
Yeah, we are. Yeah, people are still gung-ho, at least for another week and a half.
But like I said, you've just talked to a lot of your family. You know what's going on. You're reminded. It's fresh in your mind. What do you want to do with your estate if the worst case scenario happens?
Yeah.
And who do you want to help you with your estate if the even worse state happens and you didn't die, but you're unable to do anything for yourself?
Yeah, exactly. So think about the beneficiaries. Just it's one of those times of the year where maybe it's a good idea to go through it. It's like when they say, when are you supposed to check your smoke alarm? They set like a Memorial Day or 4th of July or something.
I check it when that darn thing starts beeping.
They were trying to associate a holiday with changing your smoke alarm. I honestly can't remember which one it was. But this may be a good time, beginning of the year, to be thinking about your beneficiaries and making sure that all that stuff is up to date. Because it's as much as you want to think that you've got everything set by the time your estate has to be settled and you're gone, it may be probably too late at that point to do anything about it. So, okay, that's one thing. Now, here's one that we talk about. I try to remind people every year in the beginning of the year, and that is think about required minimum distributions. Now, there are two schools of thought, well, probably more, but some people say, well, don't take any of your required minimum distributions until much later in the year. But Professor Plum, we've done videos on this before, and you have said many times that the beginning of the year is generally a better time. You believe is a better time for you to take your required minimum distributions. Can we go over that for just a moment?
Well, I'm a fan of taking them earlier in the year for a couple of reasons. Now, for some people, they didn't like the way it worked out last year. Obviously, we're talking about people who do not need to spend their required minimum distribution, because people who need to spend their required minimum
are taking more.
They're taking it when they need to spend it,
yes,
and they're satisfying their RMD, their required minimum distribution. And it is, just as a reminder, it is age 72, and it doesn't matter when you turn 72 this year. If you turn 72 this year, at any point, you have a required minimum distribution. And any distribution you take at any time during this year is a required, it qualifies or
goes
satisfies
toward, yes,
the required minimum distribution. Your birthday may not be until December 30th. You just turned 69 a couple of days ago. And you are 60 or 71. I'm still in the old age too.
Right.
You just turned 71 a couple of days ago, and now you're starting a new year. And this is the year, almost 12 months away, that you turn 72. Mm-hmm. You have a required minimum distribution this year, and you don't have to wait until December 30th to take it. You can take it now. It qualifies because they're not looking at the day you turn 72. They're looking at the tax year you turn 72. And so you can start taking your required minimum distributions now. Now, again, talking to people who do not need to spend it, you do not have to take them in cash. You can take them in kind, as they say. So you can transfer shares of mutual funds, shares of a security. You can transfer the actual asset from your IRA into your personal name, and that qualifies as a distribution, and it will satisfy the required minimum distribution.
So, in other words, if I'm holding stock, XYZ stock in my IRA, and the stock is down,
and it's a stock I plan on holding for a long time anyway.
Yeah, but I need to take some of that out of my IRA.
I need to take something out of my IRA. I can take that stock out of my IRA.
But I don't have to sell stock.
You don't have to sell it. You just tell your brokerage firm to transfer, X number of shares of that stock from your IRA account to your personal individual brokerage account, and you'll be taxed on the value on the day that it leaves the IRA. Now, last year, that didn't work out so well for people that wanted to keep that stock long term because, January, things still looked kind of nice.
Well, they were the values were still pretty high.
They were pretty close to the highs, and then the rest of the year we know how that went, not so well. And so now you paid tax on. Let's say you took $10,000 out, and you're paying tax on $10,000, but you're looking at that security and it's only worth
$7,000.
Something less. You're saying, I had to pay tax on. Yeah, you did, unfortunately. Now you could sell it and take a loss on that, X amount of dollars that you lost, and then wait 30 days and buy it back. But the markets go up. It's not every year the market goes down. This was last year was the year.
So what you're saying
I
is
do like taking it early so that if it goes up, which is the more common aspect, that growth is in my personal account, not my IRA. And it's a stock I'm not going to sell. I don't want to sell, so I'm not realizing the gain. So it's kind of like a deferral. And I get to satisfy my RMD, let it grow, and someday when I pass away, according to current law, I won't pay tax. I'll be dead, but my heirs won't pay tax because of the step up in basis. Every once in a while, it doesn't work as well, like we saw in 2022, where the stock market went down. And maybe it would have been better if you had the perfect, foresight to know that the account was going to go down by 20% to wait until the end of the year. Of course, if you had that perfect vision looking forward, you would have sold the security in January rather than anything else. But nobody has that kind of vision. So I like taking them early. I like, putting it in my personal account. That way, if it goes up, I have it in my personal account, not my IRA, so it doesn't affect my RMD in the future. If it goes down, I could sell it, take the tax loss, and I've got it done for the year.
Yeah, that's an important thing.
Putting it off until December 30th, it can screw things up because maybe the brokerage firm is closed that day, or you can't get a hold of anybody, you can't get it sold, or something happens. Your computer, you're going to do it online yourself, and your computer crashes the day before, and you can't get online until after the new year, and you miss your RMD. And missing that RMD can be quite expensive.
It can be, and what we talk about is missing your RMD is 50% of what you were supposed to take out. Is there's a penalty tax?
There's a penalty tax, yes.
Percent. So if you had to take out $10,000, you're going to have a penalty tax. You'll have to pay the $10,000 plus you're going to have a penalty tax.
Well, at some point you got to take that money out of the IRA anyway, but then you got to pay that $5,000 in this example.
Well, yeah,
penalty.
exactly. So you don't want to miss it. Now, a couple things on this point that you just mentioned. You said if you're turned 71, if you're 71 and you don't turn it until the end of the year, 72. December 30th. I mean, for this particular individual, they could technically, they would still be okay if they missed the December 31st
first required one. So let's say you turn, my hypothetical, you turn 72 December 30th of this year, 2023, and you don't think about it, you forget about it, you don't deal with it. You do have a required minimum distribution for 2023, but you can postpone your 2023, your very first one, required minimum distribution until the first quarter of next year, 2024. Mm-hmm. But you also have a 2024 required minimum distribution that can't be postponed. And so
you got to take more.
You would end up taking 2 distributions in 2024 in that hypothetical example. So postponing makes sense if you're making a lot of money this year, you're going to quit towards the end of the year, you had a windfall this year of some kind of taxable event. You're planning on selling a rental property, and and you can postpone it into 2024, where 2024 may be a lower tax year than 2023. But that's probably the only real reason to postpone taking the required minimum distribution if you turn 72 during this tax year.
Yeah, if you've got to take 2 RMDs next year, it's going to add obviously to your income.
Right, it adds to your adjusted gross income, so it's either going to affect your Social Security, the taxability of your Social Security, it's going to affect your tax bracket, or it's going to affect IRMA, or it's going to affect the net investment income tax, or it's going to affect all these other little landmines that are in the tax code all through the different levels.
Now, I want to just come back very quickly to the strategy, because we've talked about this for a number of years, where we talk about, as we said, it's generally better to take the RMD in the beginning of the year for a number of different reasons. Allow it to grow personally when you take it out, assuming it does grow. Now, as you said, last year, a year ago, when stocks were at their high, I think the S&P hit the high around January 3rd or something like that.
It was early. It was either December the previous year or January. January was much better than later in the year from a valuation standpoint.
But if somebody did that, if somebody had said, okay, yeah, I'll take it earlier in the year, it seems to make sense, and it's worked in previous years. What remedies might they have had? They may be skittish this year when they say, man, I paid,
once bitten, twice shy.
I took $10,000 out of my IRA. Stock XYZ was worth $10,000, and I took it out. I didn't sell the stock, but I did it in kind, and I paid taxes on the $10,000 that it was worth. But 9 months later, it was down to $8,000 or whatever, and I wound up paying taxes on value that I didn't have anymore.
Well, hopefully you got with your advisor before the end of last year and took action at that point, so that you could use, if you wanted to, you could sell it, stay out of it for 30 days, and then buy it back 30 days later. Use the loss in the same tax year as you took the distribution.
So what
that would have been last year.
Yeah. So what you could have done in like September of last year,
or December.
December, whenever it was, you would have said, look, I paid taxes on something that went down in value. If I had waited till the end of the year, it would have been better for me. What you're saying is, well, then what you could potentially do is take that stock that you paid it on, sell it.
Right. Buy something similar if you want to stay in the market.
Or if you want the exact same stock,
wait 30 days.
Wait 30 days and then buy it back.
And the 30-day has to do with what they call the wash sale. If you want to know more about that, give us a call. We'll talk about it. I'm not going to talk about it right now.
Into it now. But to sell it, so you could potentially take a loss on that stock, which allows you to deduct
the loss.
The loss.
Well, at least up to $3,000 against ordinary income, and assuming you didn't bankroll a bunch of losses on other things.
Oh man,
there was a lot of loss harvesting done towards the end of 2022.
Yeah,
because unfortunately the markets went down. There was the ability to offset gains that may have been distributed, offset a lot of that, so you don't have to pay the tax on that, and use up to $3,000 of those losses to offset other non-capital gain income.
I got to say that 2021 was a very good year for stocks. I mean, the S&P 500, let's just say.
And it surprised a lot of people from tax standpoints because they got huge capital gain distributions on their mutual funds.
Yeah, they did. And so, this goes back to strategy. Speaking of strategy as well, if 2021 was a great year, well, I don't have the figures in front of me.
S&P was up about 29% in 2021.
So maybe you were up somewhere 20. You were up, okay. You were probably up in 2021 more than you had expected to be, okay. That would have been a very good time to have done what we call value averaging, because before the end of the year, maybe or at the beginning of the year, you could have skimmed some of those gains off the top.
Right. If you were expecting, a 9-10% return in your growth portfolio, and you got that 29% that the S&P did, I believe that was the number, you got 19% more than you expected. So value averaging says take some or all of that excess, pull it off the top for the rainy days. And then when the rain comes, you've got dry powder on the side that you can buy back in. Now,
well, that would have been the absolute perfect strategy to use at the end of 2021, going into 2022. So for me, if that's something that I'm doing, I would have done that toward the end of the year. I would have done that maybe at the beginning of the year, do my value averaging when we're up in a year so much. I mean, to me, would have been.
And now you can look at, should I be buying back in? Where market's down 10+%, give or take, depending on the day you're looking at it. It's lower than you thought you were going to be.
You know what's funny too? People. This is just a side note. I want to do something on this sometime very soon. We are everybody was talking about in 2020 last year, 2022, how bad the markets were. Oh, it's awful. Oh, the markets are terrible. Oh, yes. I can't stand it. Right? People were miserable about the markets, especially around September, October, November, when it was looking like, we're down. But if you go back 2 years, to the end of 2020, the S&P, as measured, and I did this in early December, was up almost 10% from
2 years ago?
From 2020. 2020 to the end of, to December something of 2022, the S&P was up like 8.8 or 9%. We were higher in the midst of this awful market than we were at the end of 2020. People were thrilled at the end of 2020 to have all their money back after the COVID dip, right? Hey, look, everything's up. Everything is great. And then come back 2 years later and they're 10% higher than that, but they're miserable. And this is a human condition.
Because we expect positives, at least to some extent. We build that into it. So if it goes up 10, that's just our normal everyday
feeling. We move the goalposts.
Yeah. If it doesn't go up 10, if it only went up 5, we'd be upset. But when it goes down 10, 15 or whatever, your portfolio went down in 2022, you're really upset.
Well, that's the thing.
But you're looking too short term.
Well, and this is why I like the term happiness has a cost basis. And every time it goes up, that's your new benchmark.
True.
Right? I'd like to do something on that. That's totally irrelevant. Not totally, but it's not exactly what we were talking about in this episode. But anyway, so value averaging in years where you are up. Now, this wouldn't work
more
this
than
year.
expected.
More than expected. If you had done some value averaging at the end of 2021, I think, Professor Plum, you would have found that you're a happy person.
I think so, yes.
Right? I mean, you would have missed the downturn in many ways.
Right. And unfortunately, if you had done some value averaging at the end of 2020, you would have been not as happy at the end of 2021, but then you'd be really ecstatic about it at the end of 2022.
No, but exactly.
And for a 25, 30, 40-year-old, you shouldn't be doing this anyway. We're talking about somebody who's 65, 75.
Absolutely. No, if you're 30, 35, 40.
Let it roll.
Let her roll. Absolutely. All right. So that's a big thing. RMDs. Talk to your advisor.
Now, part of the RMD discussion, and I think is maybe even more important, is if you are 70 and a half or older already, think about, are you going to be giving any money to charity this year?
That's the absolute next thing we were going to talk about here.
Well, they go hand in
yes, absolutely.
They go hand in hand because the qualified charitable distribution, if you're going to give money to charity, whether it be, you drop money in the plate every week in church, whether you go to the zoo, the museums, your school, your alumni, whatever, the hospitals or whatever, if you're going to be making charitable donations, either systematically or even just a one-time gift, you should be thinking about doing it from an IRA so that you can get the qualified charitable distribution deduction. Mm-hmm. And that's if you are 70 and a half to the day or older. And so you say, look, well, I drop X amount of dollars into the plate at church every week. Well, figure out how many weeks you're going to go, multiply it by what you drop in every week, and then make a one-time distribution from your IRA that moves from your IRA directly to the charity.
Sure.
Now you're done. You've made your charitable contribution for the year. And you're not going to be taxed on it. The charity's not going to be taxed on it. And so everybody's happy except for the IRS. Who cares about them, right? Or actually Congress. IRS just a tax collector. But no, it works very well. And so, like I said, whether it's a one-time that you're thinking about making this year, maybe to a museum or the zoo or whatever, or it's a systematic, you can make it a one-time or do it quarterly if you don't want to do one-time, But if you are making charitable contributions
this
and
year,
you are 7.5, do a qualified charitable distribution, and it counts towards your required minimum distribution.
Now, as we've said before, I want to remind people you have to already be 70.5 this has to happen once you are at least 70.5.
Unlike the old required minimum distribution rules,
It's not the year.
It's the year you turned 70.5, you had an RMD. The qualified charitable distribution, they left it at 70.5, but it is the day you turn 70.5.
So if you're born February 1st, that would be August 1st or later.
Well, that'd be like if I were turning 70 this year, which unfortunately isn't that far away, but it's not this year.
No, but if you turn 70...
My birthday's late June.
Yeah.
I don't turn 70.5 until late December of that year.
Yes.
I would not be able to make a qualified charitable distribution until like the last 2 or 3 days of December.
Right. So it may not work for
That's
you.
Assuming I was charitably inclined.
Well, I would hope you would be at least a little. So yes, if you are charitably, as we say charitably inclined a lot, but what we mean by that obviously is you are going to give money to a charity anyway.
Right. I mean,
if you're not,
it doesn't make a whole lot of sense because, I'm giving away $1 to save 25, 30 cents or whatever the number is. I'm still out the $1.
Yeah.
But if I was going to be giving the $1 to charity anyway, this way I get to save 25, 30 cents on taxes.
I love this for people.
It's wonderful.
Who are
of age.
Of age. I think of my folks.
I can't think of a negative.
I know. I can't either. And they didn't even know about this until a few years back. Janine Stripe told them about it.
Yeah.
And they said, why weren't we doing this before? I don't want to say how much they give, but let's just pick a number. Let's say it's $50 a week. I don't know. Well, that's $2,500 a year, assuming you gave the same amount, right? Roughly $2,600 a year.
Yeah.
That they could send directly from their IRA.
Correct.
And the charity gets the money. They could probably get it all up front if they wanted to do it,
Yeah, or you can wait till later in the year.
It doesn't matter. Or do it every quarter. It doesn't matter. And then it satisfies that portion of the RMD.
And then when you get home, you go to your computer, you make a little printer slip for your charity and say, I gave a QCD, so it looks like you're putting something in the
I always wanted that too, because what they do is where my parents go, they pass it, they pass it around.
Plate, yeah.
Yes, they pass it around so everybody can see who's dropping something in. So, I mean, if you want to put a little quarter in or something, just drop it in.
A little piece of paper that says, I gave.
Yes, I gave at the office or whatever it was. Anyway, QCD is a very important part of this. And what else? Is that it?
Well, now is just the time to look at everything you're doing, looking at your budget, looking at what didn't work out like you thought it would work out. Ignore the market for the matter because you have no control over the market.
Yeah.
But other things, what is it that didn't or did work out in 2022 that you want to amend, change, do differently in 2023? And I'm talking mostly from a financial standpoint because I'm a financial planner, but you can look at this from all sorts. But this is where you want to make your changes. What did I do wrong last year? What did I do right last year that I might want to enhance for 2023? Let's make those changes so we have the whole year to deal with it.
Yeah. And if you feel overwhelmed by something like that and you think, boy, I don't know. I mean, my goodness, I got taxes coming up. I really don't know which way is up. Just go right to your financial advisor.
You got taxes coming up. Get an envelope in one of those big manila ones, and everything that comes in, put it in the envelope.
That's right.
So where did I put that form? Yeah,
I put all that stuff on the top of my refrigerator. I every year I've been doing this for like 25 years. It goes in an envelope on top of the refrigerator.
Well, you know right where it is.
I do, and no burglars think to ever look at the top of the
Plus, why would they steal your tax forms?
Well, I don't know. Isn't that the big thing now? Identity theft? I don't know.
That's true. Yeah.
So anyway, things that you need to be careful of, things that you need to look out for, things you need to be thoughtful of. But if you don't want to do that and you find it overwhelming, talk to your financial advisor. That's what Professor Rick Plum is here for. That's what the advisors at Lucia Capital Group are here to help you out with. And they would love to help you do it. We've got people already. I mean, here we are so early in the year. We've already got people doing their planning for 2023. Saw them this morning. So
now's the time to do planning for 2023. December of 2023 isn't the time to do planning for the year because the year's over.
No, and we had said that last month at the end of 2022 when we said, there's only a few things left that you can do and you want to do them soon. But now that we've got the rest of the year to look forward to, almost a full 12 months, it's a good idea to do that. Talk to the folks at Lucia Capital Group, the advisors, 800-644-1150, 800-644-1150. They do this for a living. They enjoy it. They really do. And they're good at it. You can also go online, of course, to luciacap.com. All this information is there, luciacap.com. You can get blog posts, you can get videos, you can find out information about upcoming webinars. We're going to be doing a few more webinars this year, once again, as well, retirement and Social Security and all that. So check them out at luciacap.com. Also, Spotify. You want to download our podcast every single week. You can do so at Spotify. Subscribe to it. Get it delivered right to your inbox. Click on the link, as many of you are already doing, and have a listen. You don't want to miss a single episode. I'll try to talk about this next week. It won't be for the entire podcast. Had a question. I ran into a fellow by the name of Paul. I was talking to him a couple weeks ago, as a matter of fact, and he had some questions about HSAs.
Oh, we don't hear a lot about them, but they're still an important planning option.
Yes, and he's also, I think, a friend of yours, and so he had some questions, and I said, he asked me personally, he says, I love your podcast. He said, can you talk about some of this stuff? So I think next week, I don't know that I can make a full episode out of it, but we can talk about it next week, health savings accounts.
Okay.
And we've talked about before the triple benefits of health savings accounts. So maybe we can talk a little bit about that. But he had some questions on that about, we'll get into it. So, Paul, I want to make sure I was listening. All right. And any of you also have suggestions on topics, please let us know. Go to luciacap.com. Go to the area that says find your answer, and you can send us an email as well. Out of time, we thank you so much. Happy New Year once again. I can still say that, right? If you're listening live, Happy New Year. You don't want to. You can't say Happy New Year to somebody in like March, but I think early in January when you're doing it live, you can say that, right? It just sounds dumb.
Live, yeah.
Yes. Happy New Year. All the best to you in 2023. We'll be back again next week for Professor Rick Plum, Certified Financial Planner Professional. I'm your non-advisor host, podcast host, Johnny Dean. Thank you for listening. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.